Hello everyone, this is Fred Wilson, Senior Mortgage Loan Originator at SWBC Mortgage, and welcome to another one of my weekly series titled Monday Mortgage Moment. As most of you all are aware, we're still very much in a seller's market, where sellers have the luxury of selecting the best of purchase offers that are submitted when he or she is trying to sell their home. This results in home buyers having to be very aggressive and also submit offers utilizing an escalation clause in order for their offer to be considered the best of the ones that are offered. This can result in a fairly stressful type of situation for home buyers. So the issue becomes when a home buyer submits an offer and after an appraisal is done, the appraised value is less than the sales price. What happens then? This is known as a gap. And in many cases, home buyers have to pay that difference. So what I want to do is show you a scenario whereby if a buyer does happen to submit an offer and the appraised value comes in less, they don't have to make up that gap with paying thousands of dollars in additional funds that they may not have, where they can utilize private mortgage insurance. And again, this is what we call our gap strategy. The first slide that you're looking at shows a comparison between a property for a purchase price of $375,000. The first column is fairly straightforward. This is if the property comes in at the full appraised value. So the purchase price of $375,000, and if the property appraises at $375,000, the borrower in this instance is making a 20% down payment. The total monthly payment is $2,092.37, and the total cash to close is $85,195.50. So the issue becomes, instead of the property appraising at $375,000, what happened if the property appraises at $361,000? Normally, with this gap of $14,000, this would be the amount that the purchaser would have to come to closing. And in many cases, they may have just enough funds to cover their down payment and closing costs. So utilizing our gap strategy, when the appraised value comes in less than the sales price, we're going to, instead of the borrower making a 20% down payment, he's going to make a 15% down payment. And we would take the lesser of the sales price or the appraised value. In this instance, it is the appraised value for a new loan amount of $306,850. And the difference of $375,000 minus $306,850 is $68,150. This is his down payment. And what you're looking at with this next slide is the result of utilizing the gap strategy, where the home buyer is able to utilize what is known as a single premium PMI payment. And in a side-by-side comparison, the additional closing cost the buyer is going to be subject to is $1,411.51. By paying this amount of money up front, he will not be subject to monthly private mortgage insurance. And so when we look at the gap strategy column, you're going to see the purchase price of $375,000, the loan amount of $306,850, and the total payment is going to be $2,131.26, an increase of approximately $38 a month. And then you can see the closing cost is going to be a little less with the down payment, because instead of making a 20% down payment, he's only going to make a 15% down payment. And this would result in him still being able to purchase the property and not be subject to making an additional $14,000. So as you can see, this is one strategy that can be utilized to assist home buyers in a very aggressive situation. So if you have any questions, please let me know. And I look forward to talking with you again next week, where I can present another strategy to help home buyers in this very aggressive market. Thank you so very much.